Good morning, good afternoon, folks. Hey, I'm just logging on early. We have a couple minutes until we get on with the show. So if you're listening to this via recording, you can probably just skip ahead a couple minutes unless you want to stare at my ugly mug for 2 minutes in the meantime. Seeing who we have here. We have a few folks logging in early, nice and prompt. Should open up the chat room. Maybe we could chat, see what everybody has planned for Father's Day. Yes, Father's Day. Happy early Father's Day to the fathers out there. We'll give it a couple minutes and then get rolling here. I have my trusty whiteboard, as you can see. People tend to like the whiteboard versus PowerPoints. Make sure I have my notes squared away. Going to talk a little bit about Decedent IRAs, non-qualified stretches. Going to talk a little bit about various companies that I like. It's going to be great. Phone is off, no distractions. Yeah, so Father's Day, which means I get a grill for the family, which means I get to entertain the kids like every other weekend. Which means I get to clean out the boat so that we can take it to the lake and entertain the kids. No, I love Father's Day. Maybe we'll talk a little bit about Atlantic Coast Life, Sentinel, a lot of financial engineering going on in the annuity business that has me a little bit concerned. But those two carriers particularly have gotten some pretty rough publicity lately. So for those of you that have joined prompt and early, can everybody hear me okay? So in the questions pane or webinar chat, whatever you prefer, the webinar chat or questions pane, tell me if you can see me, tell me if you can hear me, and we'll get started in about another minute or so here. Can y'all see me and hear me? Yes and yes. Cool, everybody can see me and hear me. Any big plans for Father's Day, y'all? Any big plan or plans? This might be a quiet group here today, man. We need some caffeine or something. Take some Monster. I've done my job. I've drank my caffeine, that's for sure, every morning. The only drug I'm addicted to, if I don't have my coffee, I get headaches. Eating Maryland crabs. Yeah, so you just have to throw that stuff in my face here in Des Moines, Iowa. Maryland crab. So you say that like there's a difference between Maryland crabs and Des Moines crabs. Is that what you're is that what you're suggesting? Yeah, that's probably a good suggestion. That sounds good, actually. Who knows anymore? Some of these restaurants around here flown in fresh daily, and probably is. I don't know. But I do love Northeast seafood. Monster Punisher edition. Yes, exactly. Big old monster. All right, well, let's go ahead and get started, folks. Hey, absolutely thrilled to have y'all on. We have some new faces or some new names, I should say. My name is Charlie Gipple. I'm the owner of CG Financial Group. Probably one of the fastest growing IMOs in the business when it comes to annuities, life insurance, and long-term care. And we continue to grow. This year appears to be yet another banner year. Annuities, and we didn't even exist 6 years ago, right? But annuities this coming year will probably do between 60 and $70 million. Life insurance has skyrocketed. Life insurance, we will do multiples this year of what we did last year. Long-term care has skyrocketed as well. We will do multiples of what we did last year, long-term care. One America is killing it in the long-term care space. Global Atlantic is killing it. But we continue to grow. And I would like to say, I believe that the reason we continue to grow, which this could become an issue to where I need to figure out how to scale it eventually, is because when you work with my company, you're working with me. It is outside of all the case processors and everything. It's a two-person shop here. So when you call in, it is the owner of the company who's been around for a long time that generally does not give out wrong answers. I'm a CFP, a CLU, a CHFC, and I also do joint phone calls with clients, Zoom calls with clients, full-blown retirement income plans, estate planning discussions if you're not equipped to do that yourself. But I am your partner. I am just not on your payroll. That's what I said. I am on your team, but I am not on your payroll. And folks, I think tend to like that because there's a little more ownership when the owner of the company is working with you versus that 20, 25-year-old, which I wish I was that 20, 25-year-old again. But it's different working with the owner of the company versus somebody that is hired by the person that was hired by the person that was hired by the person that owns the company, right? It's a little different of a working atmosphere when you're working with me. So appreciate the business. For those of you that have sent business to us, for those of you that have not, just know that there are almost no situations where you cannot work with me, right? Oh, Charlie, I already have my core bridge with somebody else. Well, that's a perfect example because they dual appoint, right? You don't have to get a release. You can just get another appointment through me. There are almost no scenarios to where if you are in the independent space that you cannot work with me. Oh, but Charlie, I don't really focus on annuities. Well, what about long-term care? What about life insurance? What if I can show you how to take your life insurance book and focus on annuities? But anyway, that's my quick introduction for the new folks on the call, which I'm happy to say it looks like we have quite a few. A few housekeeping items. I'm going to talk a little bit about Equitrust because Equitrust is the most capable in the industry, or I should say the most lenient, the most accommodating in the industry when it comes to decedent IRAs. You have somebody that passes away and the kid who's 20 years old says, hey, what can I do with this money? Or the kid that's 30 years old, what can I do with this money? Can I stretch it? What is an insurance company that I could put my money with? I heard that annuities were great. In almost all of those IRA situations, eligible designated beneficiary, non-eligible designated beneficiary, which we'll talk about. In almost all of those situations, pretty much all of those situations, I haven't found one yet that they don't do. They will do in pretty much all of those situations. And I tell you, this is the most disconnected subject in our industry from carrier to carrier. You go to Athene, which is one of our big companies, and you say, hey, do you take decedent IRAs? They ask you one question. Is it a spousal situation or a non-spousal situation? Is the spouse the beneficiary and the spouse passed away? No, it's not a spousal. We don't take it. You go to American Equity. American Equity is pretty darn accommodating. You go to Corebridge, you know, our #1 annuity company, the #2 annuity company in the entire country, right? You go to them and they will say, if it's a non-eligible designated beneficiary, we will take it. We will stretch it, or if it's an eligible designated beneficiary, we will take it. So we will stretch it out. We just will not take it if it's subject to the 10-year rule. So what I've just given you there is like 3 different scenarios across 3 different major companies. Equitrust, if it's IRA, not only will we take it, but we can set up kind of shadow accounts to where the required distributions can move over into that without actually leaving the account. If that makes sense, it will make sense at the end of this. So this is the most disconnected area from company to company that I have seen in our business. So we will talk about Equitrust, which is certainly my go-to when it comes to decedent IRAs. But point on Equitrust, housekeeping item #1, they are changing rates on the 21st. They are dropping rates, dropping caps on the 21st. So if you like Equitrust, if you like their story, they have a great accumulation product, a 10% cap on just a plain vanilla S&P 500. Just know there's a bit of a fire sale going on between now and 1 week from now with Equitrust. Man, I'm not even appointed with Equitrust, Charlie. I talk about this all the time. Do not get infatuated with appointments, right? Unless, Kenny, you're in one of those pre-appointment states, which most people are not. Don't get infatuated with appointments. Here in the state of Iowa, if I'm not appointed with XYZ company, it doesn't matter. If I have a client coming into my office and if that's the product I want to sell, can I do it? Folks, can I do it here in the state of Iowa? Absolutely I can, right? Because Iowa is not a pre-appointment state. So I've talked about a couple different things there, dual appointments. Iowa is not a pre-appointment state, nor is about 90% of the other states out there, right? So if there is a product or whatever that we talk about today that you want to write, you probably can do that. Bullet point number 2, before I go on to the third one, which is the last one, replacements. I used to think that replacements in general, and the industry used to think that replacements in general were kind of a 4-letter word, right? I shouldn't say that I thought that, but certainly insurance companies in general have thought that replacing an old annuity for a new annuity was a 4-letter word. I have to tell you, and I just talked with one of my guys earlier here, Mike. Mike, you know who you are. About this literally half an hour ago, and that I have never seen in general more justification for annuity replacements than what I see today. Am I wrong, folks? You tell me what you think, or did I just say an evil thing? I have never seen more justification for replacements in general, it's case by case, than what I am looking at today when those annual statements come in from agents, consumers, and compare that to the products available today. I have never seen more justification than today. What do I mean by that? Policies that were issued in 2015, 2016, they're renewing at like 5% caps, 4% caps, right? They're still renewing 9 years later, 8 years later, 10 years later at 4 or 5% caps, because that's effectively what they were locked in at when those policies were issued. So now you're looking at these statements, you're looking at Corebridge, it has 11.5% caps currently, right? And you probably are, a lot of agents are thinking, man, is there a way that I can move this from here over to there? The answer to that question is usually you can, right? Most carriers say that we will accept a replacement as long as the net market value adjustment, the net surrender charge, including market value adjustment, and adjusted for the premium bonus that you have on the new product, right? As long as it's not any more than 3% or 5% or so. So you have something that has a 5% surrender. So you have something that has a 5% surrender charge on it. It's renewing at a 5% cap. You're looking at that and it's like, oh, 5% surrender charge. It's got a 5% cap. But over here, we have an 11.5% cap, right? Can I replace this for, and let's say this product over here has a 5% premium bonus, for instance. Can you replace that? Should you replace it? You probably should consider replacing it. Because 1, the premium bonus will offset the surrender charge, and 2, you are doubling that client's cap. So just a reminder, as you look at your book of business there has never been more justification for maybe possibly moving that client's money to a new policy. Lastly, I took off Sentinel as well as Atlantic Coast Life off our website. If you go to our website, you'll see updated pretty much weekly. I'm going to show you here, cgfinancialgroupllc.com. Top multi-year guaranteed annuity rates, right? Most of you use this as a resource week after week. Now, before you write any case, make sure you verify with me that the caps or the rates, I should say, are indeed updated, right? So 2-year guaranteed annuities, MIGAs, GBU is killing it, 5.5%, the 5th largest fraternal company in the country. Awesome company. But you're going to see some absences here in the 3-year category. Whoa. Where's Sentinel? Where's Atlantic Coast Life? The 5-year category, they're not in there anymore. There has been a ton of negative press when it comes to 777 reinsurance, when it comes to Sentinel and Atlantic Coast Life's parent company. We're talking ratings downgrades. We're talking their reinsurance company, 777, doesn't even have any financial ratings, I don't think, anymore at this point. So what's happening there is a lot of creative financial stuff that, frankly, I think is ultimately going to come back and bite these companies. Doesn't mean the clients are going to lose all their money or anything. I just think it would be remiss and probably irresponsible if I continued to, I never really marketed them, but I had the rates on the website. So just know Sentinel as well as Atlantic Coast Life, just kind of know that there are some concerns out there about those 2 companies. Any questions on any of this as we get into the tax stuff, the Decedent IRAs? Any questions on any of that? You probably read my email, that analogy that I put out there, where I'm going to open up an insurance company, going to have a private equity company that I'm also going to own. You know, the client's money is just going to flow back and forth, and we'll all prop each other up. That makes it look good. Well, what happens when one of those goes bankrupt? A lot of bad things happen. Okay, so let's come back to this. I'm going to get rid of my share screen, and boom. So it's just me and my whiteboard. Let's say the year was 2019. So the year was 2019. And of course, the IRS, the government, has always had rules on once somebody passes away with an IRA that has not been taxed yet, that IRA tax needs to come from somebody, right? And usually that somebody is the beneficiary. So they need their taxes done. This is the notion of required minimum distributions. Once you hit age 73 or 75, whatever your RMD age is, you got to pay the taxes that are due. Well, when it comes to IRAs, there have always been rules that when a person dies, taxes need to be paid on that IRA. It's just a matter of when. Is it a 5-year rule? Is it stretched out over the lifetime? So I'm going to show you an example in 2019, what the scenario may have been. So let's say the year was 2019 and somebody passed away with $1 million. So John Doe passed away with $1 million. What were the options available to this non-spousal beneficiary? Folks, what were the options available to the non-spousal beneficiary? Yeah, Lyle, thank you for that. AM Best has withdrawn the financial strength rating of C- and the long-term credit rating C- of Bermuda-based 777RE. And the relevance of that is they are the reinsurance company that Sentinel, as well as Atlantic Coast Life, as well as their parent company, that they utilize. So when a reinsurer that backs the liabilities of me, an insurance company, goes bankrupt, for instance, which they're not yet, I haven't read anything like that, then what happens? The promises to the consumers are dependent on the strength of that reinsurance company. So that's what we're dealing with there. But what were the options with this one? Let me ask it another way. What usually happened with that $1 million when John Doe passed away and Jimmy Doe says, okay, so I'm the beneficiary and I have $1 million there that I can do basically whatever I want with. What did Jimmy Doe usually do with that money? What Jimmy Doe usually did was he cashed it out. What happens when Jimmy Doe in that first year cashed out that $1 million? And by the way, the two rules at the time, to simplify, were you got to cash it out within 5 years, or you can do something else, which we'll get to in a bit. What Jimmy Doe did when he cashed out that $1 million, what happened is maybe that $1 million was reduced by a huge tax bill, right? As in $300,000, $400,000. So now what is left of Jimmy Doe's money, or John Doe's hard-earned money that he died with? Pass it on to Jimmy Doe. It's immediately been diluted to $600,000. That was one option that was available to Jimmy Doe. Another option, however, which was my favorite option, which was the option that I helped a lot of agents with, is when the agent comes to me, 2019, because it was so simple in 2019, said, hey, Charlie, so I have a beneficiary, Jimmy Doe. His dad passed away, and Jimmy Doe has $1 million sitting over at whatever, American Equity, right? $1 million sitting over at American Equity. I say, okay, so has a death claim been done? Nope, death claim hasn't been done. Okay, so Mr. Agent, Mrs. Agent, what's the plan with that? Well, Charlie, I'm looking to you for the plan. Well, here is what I would suggest. What I would suggest is we maybe move that $1 million over to Equitrust. Move that $1 million over to Equitrust, and we stretch it. We stretch it because this was available in 2019, right? In 2019. What does that mean, Charlie? What does the stretch IRA mean? It means that $1 million can now be stretched over Jimmy, if he's 40 years of age, then he has, let's say, a 40-year life expectancy, right? Depending on what that table shows, the IRS table shows. He has a 40-year life expectancy. So what does that mean? It means that he can move that $1 million over to Equitrust. You got a nice case, right? $1 million over to Equitrust. And Equitrust will actually take the required minimum distributions out every year, which that is and was required of stretch IRAs, that Jimmy Doe has to take those RMDs, but it's spread out over his lifetime. Not a 5-year rule, not a 10-year rule, not getting nailed with a $400,000 tax liability right away, but instead, so let's take that. Let's say he has a 40-year life expectancy. Some quick math here. On $1 million, what would the required minimum distribution be in that first year of Jimmy Doe's first required minimum distribution? This is how the math works. Then we're going to get into today what the options are. What would be a required minimum distribution if the December 31st balance was $1 million and Jimmy Doe has a 40-year life expectancy? The table 1 says 40-year life expectancy. We got a quiet group here today, man. Or maybe we're just expecting other people to answer. Nope, you're the one that's got to answer. Tell me, what's RMD? That's right. $1 million divided by 40, right? That's the factor. $1 million divided by 40. That means that Jimmy Doe has to take out $25,000 in that year and pay taxes on that $25,000. But here's the beauty. The beauty is that $1 million didn't go to $600,000, right? Which it would have had he cashed it all, took our first option, cashed it all out. That $1 million is still almost intact. He still has $975,000. And by the way, let's say you're in a great accumulation annuity at Equitrust, because Equitrust is, paid Jimmy Doe out his $25,000 based off the required distribution, but he still has $975,000 in there working for him. What's a decent interest rate, not too aggressive, not too conservative, that maybe Jimmy got in that market value indexed annuity over the next year's period of time? What's a decent interest rate? Should we say 5? Yeah, let's say 5%. So $975,000. But it's not going backwards, 5%. Let's just say roughly $50,000, which is around 5% interest. So his money, if you look at that ledger over the years at a not real aggressive interest rate, say 5% or whatever the illustration software illustrates, at the end of this first year, I mean, you have $1,025,000, which is a huge, huge difference from the first scenario. His money is actually growing versus our first scenario of just cashing it out to where it immediately goes backwards by 40%, right? And you look at the way that this works, the total wealth over not just 1 year with that stretch IRA, but over, say, a 20-year period of time. And what you have is the notion of stretch IRAs. Well, then in 2020, something happened. What happened that muddied the waters on all of this stuff, which leads us to our conversation. What was that legislation that passed that is actually the reason for a lot of our conversation today? What was that legislation called? The Secure Act. The Secure Act. So the Secure Act basically split up. Okay, if you're a beneficiary of an IRA, it's not as simple as it used to be. It used to be, are you a spouse? Because if you are, you can actually continue it yourself. Or are you a non-spouse? That used to be what it is, because if you're a non-spouse, you have all the options that a spouse does, except you just can't continue it as your own. Well, now you have this stuff like, I'll draw out kind of a chart here. You have a designated, so DES, designated beneficiary, but you also have a non-designated beneficiary. The only point that I want to make on non-designated beneficiary is this. What might be a good example of a non-designated beneficiary? So the actual beneficiary, how old he or she is, what their date of birth he or she is, which is important for purposes of required minimum distributions and all that, they're not a beneficiary. It's not a living, breathing human that is the designated beneficiary. No, to the contrary, it's non-designated. So what might be an example, and then I'm going to make a very important point on this. What might be an example of a non-designated beneficiary? A human is not designated, right? What might be an example of that? Who might be a beneficiary, or what might be a beneficiary that is a non-designated beneficiary? Boom, a trust, right? So say like a business. What about an estate? If you have somebody naming an estate as a beneficiary on an IRA, that's a non-designated beneficiary. What about a revocable trust that does not have see-through provisions? See-through. So this is where you get into the trust. Can you name a trust as a beneficiary of an IRA? And most trust folks, most tax attorneys will say, it's a slippery slope there, because you may actually be hurting the scenario if you set a trust up as a beneficiary. That's when I go a little deeper and I say, well, but a revocable trust, to where the beneficiaries of that trust are actually designated and their ages and everything are designated, that's a revocable trust with see-through capabilities, which would actually make that a designated beneficiary, right? But many trusts, a business, for example, a charity, for example, irrevocable trust. There's not somebody designated. So what are the rules there with a non-designated beneficiary? You got to cash it out within 5 years. That's the 5-year rule. You got to cash it out within 5 years. So it's not even as lenient as the dreaded 10-year rule, right? So this is the foundation of, man, Charlie, why do people tell us that we should not set up a beneficiary of an IRA, a trust as a beneficiary of an IRA? I'd say, first of all, there are exceptions to that, right? A revocable trust that has see-through capabilities, that can move over into this column. But here is why: because it accelerates the taxation versus the 10-year rule, or versus a stretch IRA. All right, so that's the only thing that I wanted to note on that. Does that make sense, folks? Why? Well, number one, why I mentioned non-designated beneficiaries, but then number two, why it may be seen as a risky proposition to have trusts as beneficiaries. That's why. Now, there are exceptions. And by the way, I'm not saying it's always bad to have a trust as a beneficiary, even if that trust is a non-see-through trust, right? Because maybe you have a spendthrift situation where that kid getting the inheritance, it needs to be controlled. Maybe you have drug issues there and stuff. Then the benefits of having a trust as a beneficiary of an IRA probably are going to outweigh the additional tax liability than a non-designated beneficiary. So now you have designated beneficiaries. What are the two classes, folks, of designated beneficiaries? And this is where 90% of the situations are going to occur, the designated beneficiaries. What are the two classes of designated beneficiaries? And then I'll just simplify it down and say, here's what you're going to run into the most. This one right here, boom, the spousal situation. This one right here, this situation. That's right. Here are the two classes of designated beneficiaries and what you hear about the most. And by the way, we're talking the death happens after 2020. So the Secure Act says that, hey, death that happened prior to 2020, let me ask you a question. My scenario, 2019, right? Is that case still out there? Is there somebody right now stretching an annuity over at Equitrust still, even though if death were to happen in the year 2020, does that scenario still exist? Does that actual client still exist? Absolutely it does, right? So it's important that I talk about pre-2020 because, heck, maybe 6 years from now, it's out of surrender charges at Equitrust. There are better products. Are there companies that will take that stretch IRA where death happened in 2019, you move it over to that company, and that company will stretch that existing Stretch IRA. Yeah. Equitrust would do that. Equitrust would do that. That's one example. American Equity would do that. Just know, here's a very important thing, that all of these companies that do decedent IRAs, stretch IRAs, they usually limit the amount of or they usually limit the products that are available for the decedent IRA money to go into, right? So just know it's generally not the entire company's portfolio. So now moving past 2020, you have this stuff right here, right? So let's just say, to simplify it, that's the 5-year rule, 5-year rule. So John Doe has his estate as the beneficiary, which is not smart. That's a non-designated beneficiary. That $1 million needs to be cashed out within 5 years, which means a big tax bill here, right? So designated beneficiaries, you have really two different kinds, right? You have an eligible designated beneficiary, eligible. I think what do they call it? Where you can't write, whatever. What do they call that? I'm drawing a brain cramp, where you can't write, or what you read, you're actually interpreting as something else. What do they call that? Somebody tell me. Dyslexia. Yes. What was that movie where somebody said something? It wasn't dyslexia, but I think I'm dyslexic or something. And the other guy says, "Really? You can read minds?" What movie was that? It was, I think it was a Ben Stiller movie, but you have eligible and non-eligible. Eligible. All right. Now, what does this Zoolander, Mitch, my guy, Zoolander, yes. So you have eligible and ineligible. So folks, I'm going to show you something here real quick, and then we're going to dig in. I'm going to share my screen here. And this is what I refer to all the time. Me, the person that writes most of this stuff here, right? Here's what I do all the time. Let's say you have somebody that was born in 1961. I'll ask you folks, what's the required minimum distribution age for a person born in 1961? Have you memorized all this stuff? I know I haven't. What is the required minimum distribution age for somebody who was born in 1961? What is that RMD age? Nobody knows. Most people don't know, right? Because you know that changes have happened. You haven't really memorized it. So here's what you do. Nope, it is not 72. You go to cgfinancialgroup.com, LLC.com, and if you're an agent with me, you've registered for the agent portal. It's certainly not 67. Nope. You go to the agent portal login because you've already registered. And here is what I do all the time, multiple times a day as I'm dealing with these complex cases. I'll go to the left, the CG Academy, and let's see, what are we dealing with here? Nope, not even 73. What we're dealing with here, our entire conversation is taxes, right? So you have hundreds and hundreds and hundreds and hundreds of articles, videos, white papers behind 30 or so, 40 or so of these topics. You can search for it here, or you can just go, we're talking about taxes here, folks. And for purposes of this webinar, I actually brought these to the top. All right, so required minimum distribution reference guide. Yeah, Charlie has this out here. IRA beneficiary distribution guide, which, you know, there's a method to the madness. That's why I'm coming. Annuity taxation. So money comes from a bank account, is put into a single premium immediate annuity. That 20-year-old takes a 10-year period certain payout. Is it taxed? No. Or is it penalized? No. A 20-year-old, let's say a 30-year-old putting $100,000 into a SPIA, taking a 10-year period certain payout, it's not penalized. But they're less than 59 and a half, Charlie. Well, as the white paper says, they never had the money deferred prior to that. And SPIAs that weren't, so all that stuff, right? We have understanding the 1040 form. That's a webinar. What else do we have? Estate planning stuff, indirect rollovers, direct rollovers. So anyway, so RMD age, boom, let's go to that. Like, dang, I forgot what it was. That is the RMD age. Well, you have a reference guide here, like 5 different pages. This is a white paper on when are the required minimum distributions for each person. But the point of bringing you here, yes, to tease you with that, is basically what my whole presentation is today, right? So let's go to the sheet that lays out what are the options for decedent IRAs. What are the, so here's a little cheat sheet. Or in other words, what is an eligible designated beneficiary? Then we're going to click off of this because this is a lot of information here, right? So after 2020, we're broken into two major categories: eligible designated beneficiary and non-eligible. An eligible designated beneficiary is a surviving spouse. Two major groups here of these five, I would say. And can everybody see my screen okay? I want to make sure everybody can see my screen okay. Been there, done that, where I'm sharing something, but it's not being shared. So can you see my screen okay, where we're looking at this white paper that we have on the CG Academy out here? Can you all see it? You see it? A lot of times it's going to be a surviving spouse. So what does this mean? Okay, so we're dealing with an eligible designated beneficiary. That is a surviving spouse. What that means is, and we could actually go back here if we really wanted to, look at our cheat sheet. Well, a spousal situation, what are the options? So here's what happens in practicality. An agent calls and says, hey, the surviving spouse is the one that's going to get the money, right? Death has happened. It's over at another company. Here's what I tell them the options are. Number one, and the most common, is it's her own. As a spouse, she can take it as her own. That's the first option that she has. And what happens 90% of the time? That is now her IRA. She can retitle it. It is now her IRA. Number two is she can, of course, cash it out. Options are always available to just completely cash it out, right? The IRS says, regardless if you're an eligible designated beneficiary or non-eligible, you always have that option to cash it out. Well, of course, they want their taxes, right? And the third one, of course, if you're a surviving spouse, is you can stretch it. You can stretch it. So she can, even if she's 40 years old, she can choose to do the stretch thing. Why would she do that? Because she doesn't want the 10% penalty for cashing out prior to age 59 and a half, right? She doesn't want that, but maybe she wants that liquidity without the 10% penalty. But there are actually five options, but those are the three major options for a surviving spouse. What about these eligible designated beneficiaries that are not a surviving spouse? The exact same options, except for one thing that I just mentioned that the spouse has. What's the exception to the rule with all of the other designated eligible beneficiaries? So let's say you're a child. Let's say you're a beneficiary that is 8 years younger than the person that passed away. What can they do? Can they do a spousal continuance? No, no. Assuming they're not a spouse, they can't do a spousal continuance. Well, can they cash it out? Oh, you bet they can. Can they do a decedent IRA? Can they do a stretch IRA? The answer to that question is absolutely. That I just explained prior to 2019, for this group of folks right here, this group of folks right here that you see on the screen, they can still do the stretch IRA, meaning they take required minimum distributions based off of their lifetime. That 40-year-old that has a 40-year life expectancy, required minimum distributions are going to be only, what, 2.5%, at least in that first year, right? And then you stretch it out over the lifetime. I'll show you an illustration from Equitrust that shows how big their wealth can get over, say, a 40-year-old's lifetime, right? So in short, somebody passes away at another company, you call me up and you say, Charlie, here's the deal, $1 million decedent IRA money. What can we do with it? Here are the two questions that I ask every time. How is the beneficiary related to the person that has passed away? So you're looking for my advice on what can we do with this money? Which, if you don't get anything out of this today, at least remember, I'll call Charlie. And that's what some of you will do. You know what? I'm just going to call Charlie, which is a good strategy. Why? Because this is a lot of stuff here. So the number one question is, how is the beneficiary related to the person that has passed away? Is it a spouse? I just discussed the spouse situation with you. Is it a kid? You know, if it's a kid, that tells me that the kid is probably not an eligible designated beneficiary. Why is that? because most kids are going to be more than 10 years younger than the IRA owner, right? E is an important one. So if somebody passes away and passes that IRA, or the beneficiary is somebody that's 7 years younger, can that person, so let's sum it up with this example. Somebody passes away at 47, me, I'm 40 or 46. I pass away at 46. My beneficiary is a 40-year-old. Is that person an eligible designated beneficiary? Yes. Which means, can that person do a stretch IRA? Not the 5-year rule, not the 10-year rule that we're talking about. Can that person do a stretch IRA? In other words, what is this saying right here? Then because that person is an eligible designated beneficiary, I know I'm hammering on this, but I want to. Can that person stretch that IRA over their very, 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 very long life expectancy? Yes, that's a point to all this. A, B, C, D, and E has the stretch IRA available to them versus cashing it all out at a certain point in time. But number one, how is the beneficiary related to the person that has passed away? Is it a spouse? Is it a kid? Is it a friend? And number two, how old was the owner when he passed away? How old was the owner when he passed away? So let's say that that owner was 75 when he passed away, right? There's a reason I just showed you the required distribution chart. They're 75, which means they were born in what, 75, let's just call it 1950. Has that person taken their required minimum distributions yet? The answer is yes, they have. Actually, hold that thought. Hold that thought, because I'm going to get to that in this section right here. We need to know if the person that passed away has crossed their required beginning date, their required minimum distribution beginning date. But before I go there, what are the non-eligible designated beneficiaries? Well, a designated beneficiary, which means not over here, right? Not a trust, not an estate, whatever, but a designated beneficiary that is anybody other than this. For instance, a kid that is 30 years younger than his or her dad, that is a non-eligible designated beneficiary because it doesn't fall into any of these. So here are the two most common things that you will find to distill it all down. Number one is the eligible designated beneficiary. That is the surviving spouse. What does she do most of the time? The death claim is handled over at the other company. She's now the owner of that policy. Boom. You do a transfer, a direct transfer over to whoever, Equitrust, for instance. And it's her policy. I mean, there are no required distributions or anything like that. Technically, there is a required distribution if her husband was past the required beginning date, has to take it that 1 year, but then there are none if she's less than her required beginning date. But the spousal situation is the first most common. The second most common is what falls into this world right here, the non-eligible designated beneficiary. And this is that. Jimmy Doe is now coming to us and says, okay, my mom passed away. My mom passed away. Yeah, years back, it was my dad, but my mom passed away, right? And it's this year. The year is 2024. He says, my mom passed away, comes to you, the agent, says she had $1 million. My mom passed away. What can we do with it? What do you do? Folks, what do you do when somebody comes to you and says, what can I do with the $1 million that's sitting there and I need help with, and it's IRA money? So what do you do then at that point? Hint, hint, wink, wink. What do you do when a client comes to you and says that? Call Charlie. Yes. You've been listening, Bill. You call Charlie. If none of this, then you call Charlie. So you call Charlie up, and that's when I ask these questions. How old was the person that passed away? Oh, that they were 80 years. Mom was 80 years of age. Okay, so here's the deal. What we can do is that $1 million, it's subject to the 10-year rule. It is subject to the 10-year rule. So here is the non-eligible designated beneficiary rules. that they need to cash it out within a 10-year period of time, period. So by the year 2034, all of that $1 million needs to be liquidated. But I need to know how old mom was when she passed away. Well, Charlie, why do you need to know how old Jimmy Doe's mom was when she passed away? Because when we move this money over to Equitrust, we need to know if there are required minimum distributions. Because remember, she was taking those RMDs if she's 80 years old. So between now and the end of that 10th year, does Jimmy Doe need to take RMDs? The answer is if his mom was previously taking RMDs. So what I'm explaining here is you have two categories of folks here. Died prior to required beginning date, died prior to required minimum distributions, and died after. So if mom died after she was taking required minimum distributions, well, Jimmy Doe still has to cash the money out within 10 years in either of these cases. But the question is, does he have to take required minimum distribution on years 1 through 9? In this case, absolutely he does. Now, it's based off of his life expectancy, those required distributions at that point in time. It is not based off of his mom's life. Well, actually, let's look at some. Charlie, I think there's an exception to that rule here. So let's split hairs here, because Charlie, I think you may be wrong on one thing. And of course, I'm acknowledging that what I just said was overly simplified. So what I'm going to do, Charlie, is I'm going to go to your cheat sheet here, and we're going to say this is it's a non-eligible designated beneficiary. Death happened after the required beginning date. So what does that mean? It means you have to satisfy the deceased owner's RMD in the year of death, right? So that's the exception that I didn't mention. That first year of death, the RMD, based off of mom's life expectancy, has to be taken. But then the 10-year rule applies, right? But not just that, but you'll see here with annual RMDs using the life expectancy of the beneficiary. So what is that saying? Mom died prior to taking required minimum distributions. There are no required minimum distributions for Jimmy Doe. He just has to cash it out at the end of the 10th year. Mom died after her required minimum distribution date. Jimmy Doe has to take required minimum distributions years 1 through 9 and also cash it out at the end of year 10. Folks, are you listening? What if Jimmy Doe says, and I hope you all get this right, what if Jimmy Doe says, but I want to stretch it out over my life expectancy, and death happened this year? Can Jimmy Doe do that? Everybody should answer this one. Can Jimmy Doe do that? Instead of the 10-year rule, can Jimmy Doe say, I want to stretch it out over my entire life expectancy, my 40-year life expectancy? Can he do that? Of course not. That's right. Of course not. That's the point to all of this, right? Of course not. He is a non-eligible designated beneficiary. He is a non-eligible beneficiary, non-eligible designated beneficiary, which means no, he can't do the stretch if death happened after 2020. If I were to summarize the Decedent IRA thing in about 15 seconds, it would be this. If death happens after 2020, and if you are a non-designated, non-eligible designated beneficiary, you have to do the 10-year rule. If you are an eligible designated beneficiary, you can stretch it. That's the summary, right? Over here, there is no stretch. Those 5 categories over here, there is the stretch available. In all of these cases, is there anything that we can do with the money? Yeah, absolutely there is. And what is that we could do? Well, this is where we're going to get into the Equitrust stuff here. All right, Charlie, so will Equitrust take it on their accumulation product? Absolutely they will. What if Jimmy Doe is age 60 and dad died at age 80? Can Jimmy Doe, yes, he's subject to the 10-year rule, but can he get a guaranteed lifetime withdrawal benefit? You know, he loves the notion, Jimmy Doe loves the notion that when he's age 70, having a guaranteed paycheck forever. But can he take that $1 million and put it into a product with a guaranteed lifetime withdrawal? An income rider? The answer is with Equitrust, you can, right? One more thing. So make sure that you register for the agent portal. Once you register and once I see who's registered and approve you, you can log in and you can see all this stuff, right? So white paper on annuity taxation, understanding the 1040, the tax return. What do we have here? We have 2024's tax numbers, video on capital loss harvesting. Maybe it's not that. Maybe it's, I just want to learn about annuities. I just want to learn about index annuity. We'll click on that category. We have annuities here, which, you know, a lot of these things also fall into the annuity category. Corebridge, boom, 4% rule of thumb compared to annuities. So make sure you do that. All right, let's get over to the illustrations. So as a way of introducing Equitrust, here are, you know that when you do business with me, I run annuity rate watch reports a lot. You will never be out product when you work with me because I want to see who has the best product for your scenario. So agent comes to me, says, hey, I have a couple 66 and 63 in California, $160,000. They want to defer for 5 years. So they want income at age 71. Who are the best in the country? Who's going to give them the highest income levels in the country? Well, Corebridge is up there, but that's their max income. That tapers off on the end, so that's a bit of apples to oranges. Emeritus, same thing. That's a lifestyle payout. They'll pay them on their $160,000, $20,000. But what's next in line that is actually a level payout? None of this high up front, then tapering off. Equitrust. So Equitrust has risen to the top. And this is a true example that I did recently, sent to the agent. And Equitrust has two very good rider options, right? They have their Market 7. Their Market 7 has a 25% bonus on the front, and it compounds at 7% every year. What about the Market 10 bonus? It has a 8% premium bonus, but it compounds it higher. So folks, what did I just say there? So this is product analysis 101 here, or maybe 202. With a 25% bonus and a 7% roll-up on the 7, an 8% bonus and an 8% roll-up on the Market 10. Which one do you think is best for income now? Income quickly. Which one do you think will rise to the top when it comes to income immediately? The product with a 25% bonus and 7% roll-ups as the years go by, or the product with an 8% bonus and 8% roll-ups? Which one is the best income now product? That's right, the Market 7. So you have all these different levers, right? 25% bonus, then 7%. That's going to give you a big bump immediately, which means in the early years, that looks good. But in the later years where you have a higher compounding rate, so you see what I'm talking about here, right? Well, what is 5 years considered, early or later? Well, apparently the income now product works the best. Here's another one, delaying income for 15 years, delaying income for 15 years, the same emeritus product. Then I'm going to show you the stretch illustrations, which are pretty cool with Equitrust. And we're going to be done in 10 minutes, actually on time, I think. American Equity here, but let's go down. And American Equity is fabulous, of course. So this scenario, I think we went with them in this scenario. Sentinel, you heard what I said earlier about what's going on there. But you have Equitrust. Again, we are delaying for 15 years until we take income. So it's no secret why the Market 10 with an 8% compounded roll-up is actually higher on the list than the Market 7, which is somewhere way down the list, right? Market 7 is good for upfront income, and the Market 10 is good for income later. So with all that being said, and remember, these factors, of course, the income story is not changing on the 21st, but the rates are changing on the 21st. In short, they have 4 huge products that I like. I like the Market 10, great income product. However, the point-to-point is only 7%. Well, this is an income play, in my opinion, so that doesn't really matter, right? Kind of doesn't. It kind of does matter, but kind of doesn't. All right, so what's a great accumulation product? Well, that's the market value product, right? Market 10 is a great income later product. Market value is great for accumulation, 10% cap on a plain vanilla traditional S&P 500. By the way, 7% commission as well to the street level agent. But market 7, you can see here, that has a great cap as well, but this is a good income now play. So with that, here is what we have. What we have is what are the ages here? Okay. So Charlie passes away at age 47, let's say. And my buddy, who's age 40, named Charlie's beneficiary, is age 40. So what does a real decedent IRA stretch? So because Charlie's buddy is only 7 years younger, not 11 years younger, not 12 years younger, but less than 10 years younger, Charlie's buddy can do what with this policy? He can stretch this policy, right? So assuming 0%, guaranteed 0% on this. And by the way, Charlie's buddy, who's only age 40, he's not concerned about income yet. So naturally, which product did he choose? The market value, which has a 10% cap, right? So there's a reason I was showing you that there. He wants it to be an accumulation play. Well, Charlie's buddy now has $1 million. You've moved that decedent IRA money over to Equitrust from wherever the custodian was before. And what happens here? That first year, $1 million comes in. And what happens next year? In the year 2025, Charlie's buddy has to take his first required minimum distribution. That's $22,321, roughly a 40-year life expectancy if you were to look at the tables, right? $22,321 is what he would take in that given year. The next year, that's kind of weird how it's all the same because usually the balance increases and then decreases. Every year that he ages, it's life expectancy 39, life expectancy 38. But in short, what I said about the money over, say, 20 years, look at this. So in a 0% scenario, he took out, well, he probably took out about 400 and some $1,000. He's got 575,000, right? But that's 0% scenario. So let's go to probably a more realistic scenario. Charlie puts in, or Charlie's beneficiary puts in $1 million. Yeah, he has to take out these required distributions. But hey, the accumulation value here, it's actually not going, it's not going to $600,000. It's still in the policy working for him, which means that when the market goes up, say 10%, he gets 10% because that's what the cap is, right? So over a 20-year period of time, by keeping all of that $1 million intact, of course, minus the required minimum distributions year by year, we've created $2.1 million in wealth, in addition to everything that Jimmy Doe cashed out of that policy. Kind of cool, huh? Any questions on that? Then we're going to go into the rider scenario. Does Equitrust do this? Of course they do, in almost all these situations. Now, here's something that's a segue into the rider scenario. Roth IRA conversion. So if you're in a product where the benefit base, the income base, that the income is ultimately based off of, if that is growing, there are companies that will say, okay, well, we will allow you to convert that $200,000 Roth IRA into year by year, for instance, maybe $50,000 per year. Year by year, we will allow you to convert that into a Roth IRA. So year by year, a shadow account or a mirror account, a mirror annuity has been set up to where with the mirror filling out of a form, okay, this $200,000 traditional IRA, I said Roth earlier, traditional IRA, we want to convert out $50,000 into the Roth. And you can do that year by year by year. And what happens is by the end of all this, your traditional IRA is gone and all of your money is in the Roth IRA. You can call those partial Roth conversions as the years go by. Now, with that being said, check this out. So here's a scenario we have. That's prepared by me. All right. So we have somebody who's 60 years of age, the beneficiary comes to you and says, hey, I have $1 million here. My dad passed away, who was age 80. My dad passed away, right? What can we do with this $1 million? And by the way, one of these withdrawal benefits, I understand there's a product out there that has an 8% bonus every year that goes by. Is there a way that I can get that on this $1 million? Most companies will say no. Most companies, not on a decedent IRA. So number one, dad passed away is age 80. This person is age 60. Is this person able to do a stretch over his life expectancy? So is our beneficiary age 60, the son, able to do a stretch over their life expectancy? Are they, folks? I'm going to wait for that one. Then we're going to get nitty gritty here. Good group. Good group. Nope. The answer is no. Cannot. He is. So that's when I say, all right. So subject to the 10-year rule. Also, how old was dad? Oh, well, dad was 8. Okay. So dad was taking required minimum distribution. So check this out. So Equitrust knows, because they ask in the illustration software, how old was dad when he died, right? How old was dad when he died? How old is Jimmy Doe? Well, Jimmy Doe's 60. Okay, then here's what needs to happen. Required minimum distributions. Ed Slott says this. Think of it as a spigot, right? If the dad hit a point in time where that spigot was turned on, required minimum distributions, then when Jimmy Doe inherits that money, we can't turn the spigot off. Those required minimum distributions need to continue to come in. Now, technically, they're now based off Jimmy Doe's life for that years 1 through 9, and then at the end of year 10. But Ed Slott says you never turn the spigot off. Once it's opened, required minimum distribution date for the owner, it can't be closed generally for the beneficiary. So here's what we have. The $1 million went in, right? You have an 8% premium bonus, so $1,080,000. The required distributions were paid. So Equitrust is cutting the checks for the required minimum distributions to Jimmy Doe, our beneficiary. But check this out. By the end of the 10th year, now, where is that I'm looking for? I'm going to show you something. Yes, right here. And big, that yellow line. What does that yellow line say? It says now, in the 11th year, the end of the 10th year, the entire balance of the contract must either be distributed or will be converted into a non-qualified contract. So what is that saying? So first of all, high level, Jimmy Doe, you put in $1 million. Here's what's going to happen. You're going to have to take required distributions because your dad had the spigot turned on, right? He was past his required beginning date. But here in 10 years, you can turn on your income rider. He can actually do it earlier, but I just illustrated this in 10 years. $114,000 for the rest of your life and income. That's pretty cool, right? But what's this big yellow line say? This big yellow line says, hey, we need to take this $821,000, however, and move that over to non-qualified. So what it's saying is, hey, by the end of the 10th year, even though the money is still with Equitrust, what we can do is, like with a Roth IRA, we turn it into a mirror account and turn that into non-qualified after-tax money. Why? Because that's what the IRS says we need to do. Now, just beware, taxes need to be paid, right? So Equitrust, will say at that point, do you want to pay taxes out of your accumulation value? Because that will reduce this number. Or do you want to pay taxes from somewhere else where you get your $114,000? They are so modular. However it is that the client wants it done, the numbers in the end with these well, you know what the numbers look like with these GLWBs. He can do that, participate in that, while moving that decedent IRA money over and having this happen over the next 10 years. It's a lot of stuff there. Just know that Equitrust, IRA to Roth IRA, they do the shadow account thing. Pre-tax decedent IRA money, they do the shadow account thing. And then there's a lot more to it that they'll actually do that I won't go into right now. But folks, we are at the top of the hour. Make sure you fill out the evaluation as usual. Give me thoughts. Do you have any questions? Do you have any cases you want me to work on? Put the details in that evaluation, because there's an area where you can write out your thoughts, whatever it is that you want. I hope this webinar helped. Just know that the first step should be, I'm just going to call Charlie because I don't remember what the hell he just said on that webinar. Anyway, folks, have a great Father's Day for the fathers out there. I enjoyed it, and have a good one. Evaluation is popping up right now.